anything that you can add to any of the people that are listening out there? Any advice on this?
No, I think we've covered
it.
Covered that. There's just be aware.
So the next subject I want to talk to you about is something that I might decide to do at some point. Is how to scale your business using debt finance.
Right.
What advice have you got that, and could you explain to us what debt finance is, what it consists of, and for instance, I could, say I come to you and I want to scale my business. How are you going to help me?
Yeah. Well, the nice thing is that there are lots of products out there, and what's really important is to match debt finance products with your needs. So what I mean by that is, well, let's use a simple example. It's not a good idea to buy a brand new car with a mortgage on your house, right?
Yeah.
Why? People will say, well, but a mortgage on a house might be cheaper. But the mortgage is to buy a house for the long term. A car
is a short
10 to 4 years. So you got to match. You buy it. That's why you have car finance. It's the same in business. If you're buying an asset like a car in business, there is asset finance. If you're fitting out your office, there's asset finance. If you're buying something or want to put working capital into your business because you want to grow more staff, you can get a term loan that lasts a bit longer, and that can help you grow. And then you hope that by the time you're starting to pay off that loan, that new staff is generating revenue.
Yeah, so basically you're borrowing money to cover wages, office expenses.
Yeah.
If it's an engineer, maybe, that come under a different one. Basically, this is down to growth all in the back end.
As in, you've got some expenditure you're going to take as a lump sum, and you match it with some sort of loan for that, where the revenue's coming in the future, compared to what's called working capital facilities, where we all have that monthly flow, don't we? We have to pay our suppliers probably before, Now, you don't want to take a long-term term loan to fund a monthly cash flow, because let's say you borrow 100,000 because you've got £100,000 you need this month to cover some suppliers who haven't paid you. Next month you start paying off your 100,000, and by the end of the year you've repaid it. But every month you still need 100,000.
Yeah, because you're not.
So what are you going to do?
Yeah, because then you're back to square one.
So you have a working capital facility, and there's a number of different ones. So think of it that's like an overdraft. But if your bank doesn't give you an overdraft, the other things you
expensive overdraft, so you're buying 8%.
That's cheap money these days. That's
Is
cheap
it
money.
really?
That's cheap money these days.
Interesting.
Yeah. So if the popular alternative is what's called invoice discounting. So you have
factoring, or is it not?
The factoring and invoice discount are very similar. They're both, you borrow against your invoices. So if you raise an invoice today for £20,000 to a customer, you can get that money straight away from the lender.
B2C though?
Not to consumers. Not in your business. It doesn't work. B2B. Yeah. So, but that's working capital. So every time you raise an invoice, you borrow the money when you need it, and you pay it back when your customer pays, and you use that money to pay suppliers. If you can't do invoice discounting, because like in your site, there's something called trade finance, and that's particularly relevant for construction or people working in that sort of related area. So a trade finance line, the bank gives you a facility that you pay your suppliers, or you pay your employee, your subbies, and you then have 60 days or 90 days, whatever you agree, to pay your lender.
If you could, like us, for instance, in the summer, when the summer months come in, we're like shit, and all heating companies come up against that because we're seasonal. We have got things in place to stop it, but if I'm dead honest with you, it's basically September down to March is when we make the money. But that's what's disappointing sometimes. You do lose a lot of we're working on ways on that. We've got home care, got all sorts of things in place, and it's working. Yeah. But it's a slow process. The home care, especially, I want them to go quicker. Just can't get them any quicker.
Yeah.
But that would be really good if you knew that you could ring someone up there. It's just, I'm struggling this month. Can you do this? And then as soon as we hit winter, we can then. Yeah.
And these days they're all online. They're all simple platforms. You just go onto your facility. You pay your supplier. So those facilities exist.
They give you like a limit. Like
yeah.
So there's 100 grand, mate.
Yeah. And that's it.
That's it. And then as soon as you borrow it, you pay it. Or is there any any other clauses where you pay it off in a lump sum? Would there be a clause on that, or does it just reduce your interest rate?
You only pay for what you use in these facilities, which again is why the good. So if you have a good month, you don't need it, you don't have to use it. So you pay for what.
So it is essentially like an overdraft.
Yeah, it is. But a little bit more expensive, and a bit of administration behind them. So you've got those sort of facilities, and then if you're going to go into say acquisitions, buying companies, you can have loans cash flow loans, they're called, where you can borrow money against your strength of your profits and the profits of the companies you're buying, and they'll give you money to buy up front that company. Right. And you can factor that in. You can do different things. You can have working capital facilities, term loans, secured loans. You can mix and match, but it's important to match it up.
This is why it's really important, guys. Like, you know, what you just told me, I've talked about 75% of that. Do I understand it all? A little, yeah, 75% of it, but he understands 100% of it. So if I went into anything like that, I'd go through someone like Richard, because it's his job. I won't go to him for PT, and I certainly won't go to him to fix my boiler.
No.
So ultimately, I think the point I'm trying to make is that you've got to be careful, because some people just want to sell you a product to get a commission, whereas Richard is more like broad. He uses different lenses, does what's best for the client. That's what you need. Hey, would you class yourself something like a broker? Or what
do you know, you won't see broker anywhere on my website, actually, or any material. We sell solutions.
Solution solving.
Yeah, I find solutions for you. We can go to the whole market. Yeah, of course we make fees and money out of it. We all do for our jobs and our expertise, but we put ourselves as advisors first. We do a lot of free advice. We talk to clients.
Yeah. I can vouch for that, guys.
And that's what we do.
Yeah. I mean, is there anything else? I mean, I kind of understand a lot more than I did 15 minutes ago, 20 minutes ago, than I do now. But like I said, if I was going to do anything like that, so say a company come up for sale, and I thought, because everybody talks about, I've always used my own money, and I've now realised that that's not really a smart thing to do, because ultimately the cash that you've got could be in something else, making something else. So, you know, like some people say, you know, you could put 100 grand back into your company, use your own money, or you could borrow that over a term and use that 100 grand on a different revenue stream of income.
Yeah, I think the decisions for people are not to confuse two things. One is, if you've got lots of money and cash, money spare cash, lending it to yourself, investing in yourself, is that a good idea because you're going to get a good return on it rather than paying somebody else money, right? If you've got limited cash, or you have lots of opportunities you want to invest in, which is usually the case, to be honest, with entrepreneurs, you want to do lots of things, then you can spread that leverage up. So debt is a way of leveraging up your opportunities and doing more.
So I think the word debt, if you said to somebody debt, we're trained that debt's bad, aren't we? We're all trained that debt's bad, and I don't believe that anymore. I think there is good debt and bad debt.
You can't. Yeah, there is bad debt because you get the wrong solutions. You can't. I don't think I work with. Well, obviously I don't work with any businesses that don't have debt. I've had some come to me that have never used debt, and then they put debt in place because they want to grow. They want to leverage. There's very few people in the world who have so much money they don't need to. We met a couple yesterday. Probably don't need to borrow, but even the people presenting use it, and they debt and they leverage out, and it's because it's leverage. In the same way that you would recruit good team underneath you, why do you do that? Well, you're actually doing that to allow you to leverage your own time into something more productive that can generate more income, and that's what it is. A lot of people come to me and they're growing their business and they're taking it steady. They're growing, so they don't want to take debt, that they see it as a bad thing, or they don't want the risk. That's fine. There's nothing wrong with that choice, but it's going to be a slow drip growth.
Well, if you look at all the big companies out there, they're all in debt. I mean, I could never understand how, say, £600 million companies in debt sell for good money. And I'm like, how does this work?
Well, the key thing, what I always talk about is what's your plan for repaying the money. Working capital loans we just talked about, in theory, they should just pay themselves off because the debt has come in. If you've bought a car vehicle, you're going to pay that off with the extra profits you're going to make by having another car in your business. And it's the same with everything. Whether you're buying another company, you've got to believe that having that money in the debt, yes, you'll make enough money not just to pay the debt off and the interest, but you'll have a lot more profit on top, which is what you want. And then that answers the question about why people do it in the big businesses. Venture capitalist firms, certainly in the early 2000s, leveraged debt everywhere. And the reason was because you can get a much higher multiple for your company and the profits that you make, if you sell your company for times 10 of your earnings, 10x, yeah, well, that's going to cover all the debt and all the interest and all the costs that you've incurred. Yeah, that's why they do it.
That's brilliant. Have you
leverage
anything else that you could add? I mean, if I sold my business 10x, I'd be more than happy. Would be more than happy. So is there anything else you could add before we move on?
Well, just, I guess it's on pricing and how banks, so people come to me and they're surprised. You mentioned it just now, overdraft's expensive, right? Well, let's talk about today's world. Interest rates are 5% today, as we're talking.
High, yeah. Well, I think we've had it lucky, haven't we, for a long time?
We have. Let's 5%. I mean, my age, when I actually started work, interest rates were 12, 14, right? So quite high. A bank needs to make a profit. You wouldn't expect a bank not to make a profit. So they add a margin. So your starting cost is going to be base plus their margin. Now, the cheapest debt out there from high street banks is 2.5% over. So 5 plus 2.5 is 7.5. So if you're telling me you're getting bank overdrafts at 7.5, 8% right now, that's cheap money. It's good money. Okay.
That makes sense.
Makes sense?
Yeah, it does. I think it's because like in our industry, if anything, I think every industry is the same. I can't complain about my own. When you get the situation what the finance is in at the minute, we're doing B2C, so the customers can't afford it, and they really can't, and a lot more are failing finance as well. Ours is Navuna, which they are a very straight company. They have just one rate, year in, year out. So some companies I could get you finance for a higher rate if you was a higher risk. Yeah. That's what I'm looking at doing. I am honestly going to have to do that because if some people can't pass finance, obviously we lose that sale. But I just think we're just in a completely different world than we was before 2019.
And that money I talked about there is for what a lender believes is to be low risk. So they've got lots of assets and lots of profits. Once you get into you need some working capital, maybe you haven't got the profits, but they're going against your invoices, they actually then have to add a risk margin to it as well. And then when you're talking about the companies that do unsecured lending, so remember, they've got no security, they have to factor in.
Risk, isn't it?
Yeah, so the bit that you've got to remember is, let's say they have 25% of their loans default. They have to cover those defaults by charging everybody else.
I get it, yeah.
So that's why you find the rates vary so much, and unsecured lending tends to be at least 12% plus. I'm at the far end of the extreme. I had one client last year who desperately needed $150,000 to pay a VAT bill, because if they didn't pay it, they would lose all of their rights under a payment plan or their tax. So it was going to be, which was a lot, and they needed to pay. The money they got quick based on their company, they had to pay, ready for this, 6% a month.
It's a lot, isn't it? It's a lot.
72% a year.
Yeah.
The only reason I said it was the only lender who could do this. The only lender who could do it in 2 days. But the only reason I could justify it and hand on heart say to the client, you should do it, because it was a VAT return, so they were going to repay that within 2 months. They knew the money was coming in to pay it off. So pound notes wise, it wasn't going to be 72% a year. It was going to be for 2 months. It did the job, and it saved them having to get or remain their much larger £1 million tax payment with the bank. So it's worth it. So that's the kind. But if you came to me and said, and you weren't making profits, and the lender was going to offer you 50%, I just said, really, let's not do it. It's just matching again.
Yeah, I mean, I think people like your parents brought you up, didn't they, as well, saying, if you're going to scale your business, you put your hard work in. And I don't think in 24 that works. As you've got to put the hard work in regardless, but I don't think that model works anymore where, because, you saved up for your own house. These young people, whatever, there is no money to save up because it's too expensive to live. There's lots of examples out there. So we would probably look at, if we were going to scale at doing something with you so we could do it, I would rinse everything I've got first and then look at it. Like the first thing I think you've said is look at friends and family or people you trust, and then if that doesn't work out, but
that's not always a good idea, because if you can't pay them back, you're in a terrible position.
I lent my friend a considerable amount of money, and it's gone wrong.
Yeah.
So I'll get the money back, of course I will, but when?
Yeah. And there's always bad blood or something.
Well, you don't. Yeah, I didn't take the advice of my mentor about that, to be quite honest with you. I went from the heart, and it was, again, an emotional decision. I would say never make a decision to lend anybody. I mean, this was a lot of money to lend anybody money when you're in a frame of mind of friendship.
Yeah.
You need to go to someone like you and say, what do you think? And you say, absolutely no way.
Yeah.
And you better transfer all your money into this holdings account before you even think about it. But yeah, I mean, I've done that. So before we move on to the next subject, have you got anything else to say?
No, that's it. I think we covered everything. Lots more to say, but hey, it would be here forever.
It would be forever. I mean, there is. I mean, I've got emotional attachments when you meant VAT and tax and stuff, and I didn't want to get into that rant. I'm concentrating on don't get into that, which I won't. The other one was the next subject was
build your business for sale.
Business
ready for sale. Yeah.
Sorry, guys, I've got so much to remember, and I was still thinking about that Batman. So yeah, getting ready.
Yeah, very, very common question, and it's. I think the first thing to start actually is to manage timescales and expectations. All right, because people think, all right, I want to sell my business. Right, let's